Hello, everybody. My name is John Briggs, Head of Strategy for the Americas, and welcome to our latest podcast, where we will be previewing next week's FOMC meeting. I'm joined by several of my colleagues, whom I will now ask to introduce themselves.
Hi, I'm Kevin Cummins, a US Economist here at NatWest Markets.
Blake Gwinn, US Rate Strategist.
And Brian Daingerfield, Head of G10FX Strategy for the US.
All right, so let's get right into it with Kevin. A lot of things going on at this FOMC, a lot of potential changes. Let's start with the statement. I mean, just the first thing that comes out, where people are going to look at is the text of the statement. What changes do you see there?
Yeah, thanks. Probably not too many. I don't think that there'll be all that many alterations relative to the statement from the end of April, which, Fed officials, for the most part, given the fallout from COVID, really had to rework it. And they really changed a lot of it relative to the previous edition. And typically, you don't see that many changes at most FOMC meetings. They largely leave enough intact, just things that they are required to necessarily change if the outlook changes. But given that it wasn't that long ago that we had an FOMC meeting, and we're still seeing evidence of a real weak economy, I think the characterization with regard to the current situation hasn't changed enough that they're going to have to alter much in the statement.
What about on the forward guidance side? At least just starting even within the statement or some verbally that Powell might communicate later in the press conference. There's been some increased talk lately of potential to tying forward guidance to some sort of metric or unemployment rate or date or time or something that they've done in the past or something new. I mean, do we think that we're going to get much in the way of new forward guidance of import here?
Yeah, I don't think so. Not just yet. It seems like the policy outlook is still so uncertain at this point. We all know that activity came to a sudden stop in the second quarter. We're going to see, a rate of contraction that's almost unimaginable. We at NatWest have a drop in top line GDP growth of 42.5% for Q2 GDP. Job losses continue to mount. The unemployment rate is hasn't been this high since the Depression. But there's still so much uncertainty in the outlook that I don't think they can start to beef up their forward guidance just because there is such a lack of clarity at this time. So I think it's something that, they're obviously talking about it. We heard about it in the minutes. And I think in the press conference, Powell will certainly be asked about that. And he could elaborate on it a bit more there. But I think with regard to the statement itself, I think they leave well enough alone for now. But ultimately, I do think that they're going to be kind of beefing it up and, perhaps tying it to, what they've done in the past, where there are these thresholds that they want to reach of, 2% on inflation and perhaps, full employment. That's kind of a moving target. Last time around when they had that target, it was at 6.5%, or assumed to be in and around there back in 2013, 14. But now, obviously, that has moved down to about 5% or so, and we'll see. Maybe they'll even go as far as saying, their long-run estimate of unemployment that's in the SEP projections, which as of December was a little above 4%. So, that's probably something that we're not going to hear specifics on at the upcoming meeting. But down the road, I do think that we're going to get probably a bit more aggressive reaction from the Fed to make sure that people are aware that they don't expect to raise rates for the foreseeable future. And I think that that's one of the risks that, in the market that people are going to start to consider is once we do see some sort of improvement and things start to at least resemble some sort of normalcy in the US and we start to get better growth data in the back half of this year, which I think we're likely to get at least looking at top line numbers, we are likely to see some sort of rebound in the third quarter. But one has to remember it's a lot of just the way things are derived. So if you're looking at quarterly sequential annualized growth rates, that third quarter after contracting to such a low base, and you annualize even a modest pickup, is going to be almost misleading. So for example, we have almost 20% in the third quarter. That's unheard of growth before what we're experiencing right now. But I think that, the Fed will potentially want to, tamp down expectations that things are really that sort of booming of a recovery. Now, obviously, they're hoping for a very strong recovery, but I think that those headlines potentially in the back half of this year could be a little bit misleading.
All right, so then it's probably way too early for any sort of talk about inflation targeting or average price inflation targeting, that kind of thing, right?
Yeah, I mean, they've made it very clear that they're willing to tolerate inflation above 2% and perhaps make up for some lost time. Obviously, in the wake of COVID, inflation certainly is taking a back seat relative to growth, and obviously it should. But if anything, the near-term impact on inflation is disinflation. So, I think they'll want to emphasize that there's still a very cautious going forward. But eventually, I think that they'll allow inflation to go above 2% for some time before they start to consider rate hikes down the road.
All right, one more for you. Everybody's favorite dots are back. What are they going to show us this time?
Yeah, well, I think right now, I think they're pulling out all the stops. They've been obviously very aggressive in their reaction to do all that they can. And I think it's pretty clear that they're in no rush to raise rates. So I think that we're going to see the forecast show in this year and in next year and even into 2022 that they have no rate hikes for the foreseeable future in their forecast. So, they're going to remain at the zero lower bound for the time being.
All right, I'm going to switch gears here a little bit and go to Blake Gwinn. Tell us about QE. We're going to get this week-to-week stuff still. They're going to give us more of a program. What do you say?
Yeah, I mean, I think we probably lean towards the more formal announcement. The part of that goes to the justification of why they've actually been buying securities. I think, a lot of times we've been calling what they've been doing the last few months QE, but remember, E stands for easing, and I think they've, I don't think there's any argument that this has probably provided some easing, but that's not why they're doing the purchases. They've clearly stated their goal to be about supporting smooth market functioning. It was taken, these actions were taken in response to the liquidity breakdown that we saw in mid-March, massive selling of treasuries out of all kinds of account types as everybody kind of had this flight to cash. And they came in and took the other side of that. So this really was never about kind of loosening financial conditions per se, or kind of the traditional ways we tend to think about QE, which is this kind of portfolio balance, keeping lower, longer term borrowing rates. It was simply to keep markets from breaking down. That goal has largely been accomplished. So they've been tapering those purchases down, but at this point, with markets pretty much back to normal functioning, that old guidance that they've given us and the old justification for why they're doing this program doesn't necessarily hold anymore. So I think now probably would be a good time for them to kind of update those goals at the very least, kind of tell us that, okay, we're now switching into more of a mindset about providing that stimulus to the economy, keeping longer term rates lower, portfolio rebalance, all those kind of traditional thoughts around QE that are really more kind of stimulus based than liquidity based. So I think it'd be a good time to announce that. But then again, in April, you could argue that market functioning was already improved quite a bit. And they basically kicked the can down the road. They just said, hey, we're going to stick with these week to week announcements and not kind of give that longer term commitment that I would expect to have a bigger impact on financial conditions. So yeah, I think we lean towards a more formal announcement where they really say, hey, this is going to be more about fostering lower financial conditions, easier financial conditions, borrowing by businesses and consumers. And what that might mean is some kind of commitment to size, to pace, to a certain maturity structure, because none of that we've had. I mean, basically we have to wait every week to see, what securities, where along the curve they're buying, how much they're going to buy. It's kind of a mystery every week. So they could commit to one or all of those parts and give us a little more clarity. I think for our part, we're, kind of loosely looking at $100 billion a month in treasury purchases. Let's call it $80 billion in MBS. And the commitment would be kind of open-ended. So, they would basically just say, hey, we're going to purchase as long as needed and not give us that kind of fixed time frame or a fixed overall amount, similar to what the ECB's actually done, where they've said, hey, we're going to purchase until this point as of now, and we're going to purchase X amount. We could actually see them maintaining perhaps a little bit more flexibility and saying, giving us kind of a monthly purchase amount and maybe even a maturity structure, but keeping some flexibility around that.
Yeah, I think, as you said, we do lean a little bit towards a formal program, but the other reason just being in my mind that we've seen the Fed tapering these purchases down, and if you don't announce anything or some sort of plan on that, the market might assume you're going to taper it down to zero, and I don't think that's something that they want to kind of even falsely communicate now. What about the bill sector? I mean, you've written a lot about how there's a ton of bill supply coming. Markets handled it okay so far, have some concerns about that down the road, though. Do you think the Fed's going to move into the bill sector again as part of a purchase program, whether it's a formal one or still a week-to-week one?
Yeah, I still see them holding off on that for now. I do understand the sentiment, though. I mean, we put out a piece recently about what I expect to be a growing mismatch between supply and demand. I mean, one of the helpful things about the bill issuance we've seen from Treasury over the last few months is that we've had demand growing at a very rapid pace. Treasury's had an absolutely historic amount of bill supply hit markets over the last couple months, but at the same time, we've had massive inflows into government money funds. They're buying those bills. We've had inflows into prime funds. They're increasingly buying bills. And one of the more persistent and I'd say broad spread themes we've heard across the trading desk for the last few months has been various account types kind of parking cash or holding out in the bill sector until other opportunities start to arise, or they get a better view on what the next move and what the trajectory of the recovery is going to be. So all of that bill buying has really helped keep any kind of ill effects from all of the bill supply from materializing. My concern is that Treasury is going to keep issuing bill supply according to our forecast, but now we've got those demand sources starting to dip off. And I guess the question that a lot of people ask is the Fed going to step in to replace the other side of that trade? I mean, that's really, if you look back at what they did in March and what we were just talking about, that's largely what they did. Markets were, this time the supply was actually coming off of investors' balance sheets, but there was basically a giant flood of paper hitting the market, and then there was nobody to take the other side. So the Fed stepped in and took it. And so you could make the argument that we're approaching a similar type situation in bill supply, where there's going to be all this paper kind of hitting the market. If there's nobody to take the other side of that trade, maybe the Fed steps in. But I think, in the end, the Fed can probably allow bills to cheapen up a bit, allow a little bit of softness in repo, allow the Fed funds rate to tick up a little bit. I mean, just a few months ago, there were concerns that the Fed funds rate was too low. So, was the Fed going to have to hike IOER and overnight RP? So, if it does rise a little bit, if repo rates rise a little bit, I don't think that's something that the Fed needs to be overly reactive to or overly concerned about. But if they are on this kind of flexible schedule still, it would make it very easy to say, for them to basically say, hey, look, we're uncomfortable with how much bills are moving. We're uncomfortable with where repo's going, and we're going to step in. I just don't see that. I don't see them being that reactionary, and I don't think it's coming unless we saw some significant signs of stress in front-end markets.
What about yield curve control? I know that's something that you've thought a lot about. Is it a lot of conversation about it? Because
yeah. I mean, you increasingly see it in Fed commentary, and it does seem like there's at least some thought that that's eventually where they're going. But you can also tell from those comments that that's not that's not the next move. They're not teeing that up. They're not. This is not something that I think any of them expect to be around in June, and maybe even not later this year. I actually think that by kind of September, December timeframe, it's likely we end up going there. But clearly, when you look at the comments that have come out of recent Fed speakers on the topic, it just seems like they want more research. They're kind of teeing up one of these staff analysis at an FOMC meeting where they're really going to hash it out and kind of look at what other regions, have the experience with RBA and BOJ, see how effective it's been, and what's some of the pluses or minuses. You kind of need to do all that legwork before you actually implement it. So it just doesn't seem like they're ready for that in June. Which again, I think if that is somewhere they think they might be heading, to something you kind of mentioned before that last question about bills, that this kind of timing issue where they're winding down the purchases, and if they do think that by September, December, yield curve control is something they want to implement, it complicates things a little bit, because do you really want to come out and announce a fixed program today if you think that in 5 or 6 months time you may be switching gears and moving more towards yield curve control? So it's just one more complication, I think, that goes into the decision of what to do about QE at this particular meeting, because you don't want to announce a big program and then 3 months later decide, oh, just kidding, we're not doing that program, we're going to do yield curve control instead, or make big alterations to that program. So maybe that's something that actually pushes you in the direction of maintaining flexibility and kind of keeping that week to week, or I would say more likely month to month flexibility in purchases today, to leave that option open for later this year.
All right, last one. Can we finally put this negative rates thing to bed?
Yeah, I was actually laughing to myself when Kevin was talking about the dots, because I was just thinking about how much the world would melt down if somebody, if we had a handful of dots into the negative territory, because it seems like we've effectively it looks like the FOMC is effectively, well, I should say it's the FOMC and the strategist community writ large. I feel like we've pretty much put out that fire. Obviously that was all anybody could talk about when we started seeing negative pricing prop up in various financial products. But I think that's been put to bed at this point, and God forbid we come back out and reignite that fire. So I think they've done a lot of work to douse it, and they're not about to go back and stoke it again. So I doubt there will be anything at this FOMC meeting that
I know all those
in any way leaves that door open.
Yeah, and as I say, I know those dots are supposed to be kind of independently submitted, but I bet there was a memo going out about not putting those things in.
I mean, can you imagine the one guy at the table who, I say guy, just, I have a person in mind that I think would be the most likely for that negative dot scenario. But I mean, can you imagine one person submitting negative dots, and then, it's just, even if it's only one participant, if there were negative dots on that plot, I think it would just open, it just kind of keeps that door slightly ajar, which is what I don't think they want right now.
Yeah. All right. So that's basically our broad expectations. Quickly, I'm going to comment a little bit on the rates market out the curve before I hand over to Brian to talk about what this all means for currency markets and updating our views there. Obviously we've had quite a bit of bear steepening in the treasury market of late. And, there's a lot of reasons. It all kind of stems back from, the initial move off the Treasury refunding announcement and this ongoing huge amount of Treasury supply that we've had to absorb here. In addition, we've had an incredible amount of corporate supply that's been on top of it, with about $1 trillion of corporate supply, probably 1.1 trillion right now, that has come out year to date, which is almost double what it was at this point last year. What's interesting is that when you look at the 20-year or longer debt, that's actually in the corporate side, that's actually up 121%. And 31% of all the issuance so far is in longer date issues. So especially of late, we've seen a lot of heavy corporate supply out back. So in addition to Treasury supply, I think that is something that, sister supply that has been weighing on the market. Also, there's just the simple fact with the front end pinned, as Kevin alluded to, don't think they're going to be signaling anything anytime soon, probably for a couple of years through the forecast horizon in regards to rate hikes. Any better than expected data or optimism on the reopening, which has certainly been the trend in sentiment here, has been borne out in the long end. Also, just on a technical side, month end did not provide as much relief as we expected. We're turning right back to another slug of supply next week. And then what Blake talked about with yield curve control, there's definitely a contingent out there. We don't see it this early, but there is a contingent out there that thinks the Fed announces it next week. And even if they do have some QE, if there's any sort of yield curve control, that's a steeper curve. I personally think that you've had a lot of that move. And even if you look at things where like Australia or Japan and try to adjust for some of the supply demand imbalances and stuff, I think it's probably, even if we get yield curve control, myself, I think that you might have some initial steepening, but I'm not sure that how much further you go just on that. But, I do think that there is the fact that you have increased supply. You've had some rising inflation expectations, better risk assets, authorities piling on the stimulus, like we saw with the ECB, that's steepening out the Gwinn curve, not just on the issuance side, but on the fact that, with this incredible amount of stimulus, and if things reopen well, that, there is some inflationary implications. European 5-year has, advanced quite a bit lately. So, all that kind of tied together is weighing on the market. So whereas personally, I think that these levels in the very long end are attractive, given I don't think that with the overall level of rates low that you can stretch the curve that much steeper. There's just a lot of technical and flow related and sentiment related things happening here that, clearly is making it move even further, than I thought. We were in the steepening camp for a long time, but, got out of that a little bit early. So kind of want to see how some of this stuff plays out. I do think there's value in the long end of the market, but can understand if there's going to be some hesitancy there, given the fact, the veracity of the move, and indeed the range break today. You might need to see the Fed meeting behind you to get through the next round of supply, to see if the auctions go well at these levels, see what the Fed does on yield curve control, see what they do as far as QE buckets. Do they go longer? Again, that's kind of what we think before you have a little more confidence in that. And then with that, Brian, what's the outlook here for the dollar with all this?
Thanks, John. So I think it's important to remember that coming into the meeting, we're seeing some pretty meaningful weakness in the dollar, not just against the G10, but also against emerging markets. And there's a lot of drivers behind that weakness. Obviously, the reopenings are happening. You're getting fiscal stimulus. But one of the drivers is certainly Fed policy. And you think about that from two perspectives. The first one being that the policy stance is extremely aggressive and it's very easy. Rates likely to remain low for an extremely long time. And also you have balance sheet expansion that's really outpacing a lot of their peers in the G10 and likely to continue to do so. But then from a volatility perspective as well, as long as the Fed is signaling its willingness to stay aggressive, you're also putting downward pressure on market volatility, which is also helping risk-oriented currencies versus the dollar. So there's a lot of nuances to the meeting that we've been discussing on this call. I think from an FX perspective, the markets are looking at this with a dollar on the decline and wondering, is the Fed going to do anything to stem that decline? Are they going to signal some sort of newly found optimism? Are they going to try and suggest that maybe they could start to pare back some of these programs now that the economy is starting to reopen? And we think the answer is really no there, and that the Fed's not going to really stand in the way of that. And so Fed policy is likely going to remain easy and likely going to remain sort of a negative for the dollar here after really a couple years of Fed policy being a big positive for the dollar, both from a carry perspective and from a balance sheet perspective. And so we think the overall orientation of policy is probably going to be the focus for FX, less so the nuances of how the QE purchases are dealt with. And we think that overall stress is going to be policies likely to remain easy for longer and keeping the flow in the direction of the dollar weaker.
All right. Thank you very much. Thanks, everybody, for joining us. On behalf of myself, Kevin, Blake, and Brian, talk to you next time. Appreciate it.